Hello everyone. Today I will be explaining to you what is meant by the generally accepted accounting principles known as GAAP. These are the rules and principles that govern and dictate how accounting should be done. The first principle we will be looking at is known as business entity. The business entity principle states that the owner's assets and the business's assets must be recorded separately. The owner can't just go out and use the business's money to buy a car for himself and call it a business transaction. Firstly, it's for his personal use, so it's classified as drawing. And secondly, this vehicle is not being used to generate any revenue for the business. So there's no point in recording it as a business transaction, as this will lead to the business having a smaller profit margin than estimated. The historical cost principle states that assets must be recorded at the price that they were originally bought for. For example, if you bought a car 10 years ago for like 100,000 Rand or $100,000, in your books every single year the cost price of that vehicle will not change. It will always be that 100,000 Rand or that $100,000 no matter what. The matching principle states that transactions that are related are recorded in the same set of annual financial statements, and year-end adjustments are done to match money to that correct year. This means that whatever transactions happen in one particular year will stay in that one particular year. This means whatever bought, whatever sold, any money you owe or any money people owe you will still be recorded in that year, even if it goes on to the next year, even if they pay you in the following year. For example, in 2019, you may sell goods on credit to a debtor, and now they don't pay you the full amount in 2019 and they still owe you in 2020. That doesn't mean that you record the purchase in 2020. You will still record that the purchase was made in 2019, but you only received the income for it in 2020. This is the principle of matching. The next GAAP principle is the one of materiality. This means that only important items must be shown separately in the annual financial statements. This means immaterial and smaller items can be grouped together under one cost. For example, the business owns a bank account and the bank has its own fees such as service fee, interest on overdraft, etc. Now, instead of listing all these smaller transactions separately, we will group them all together and call them bank charges. This helps to lessen the burden of writing more when an accountant is doing his job. The going concern principle is the accounting principle that states that the annual financial statements are done on the assumption that the business will continue to operate in the near future. A going concern business is a business that is expected to continue operating and meet its financial obligations as they are required to be paid, rather than becoming bankrupt or closing down. The prudence principle states that a business should not overestimate or underestimate its incomes, expenses, and liabilities. This principle allows businesses to anticipate losses and to realize if the business has made a profit or not. Also proves the validity of the financial statements. It prevents fraud, as the exercise of prudence does not allow for the creation of hidden reserves or excessive provisions. Example, the deliberate understatement of an income statement because someone is pocketing the money.